Okay, one more minute and then we'll get started. All right, welcome back, everyone. It's exciting. Tonight is our first webinar of the year 2025, and we're back with the IRS. Nikki Cox is here to present on federal taxes and starting a business. As a reminder, Business Sales is a consulting firm that specializes in empowering, training, and supporting startup businesses and entrepreneurs in general. Without further ado, I'm going to turn the mic to Nikki.
Thank you so much, Deborah. Well, good evening, everybody. So, over the next few minutes, I'm going to provide a basic summary of what you need to know about successfully operating your business, as well as provide you with some of the resources that we have for additional information. Specifically, I'm going to explain the purpose of the employer identification number, describe some basic record keeping requirements for tax purposes. I'm going to define basic bookkeeping and accounting methods, explain the forms of business organizations, define what we call gig economy, and suggest how to select the paid tax preparer. So before I begin, I want to remind you that you also need to understand your state and local tax reporting requirements in addition to the federal requirements that I'm going to be going over here. So let's start first with the Federal Employer Identification Number, or EIN. And EIN identifies tax returns filed with the IRS, and as a business owner, you may be required to get an EIN. You'll need an EIN if you pay wages, if you have self-employed retirement plans, if you operate your business as a partnership or a corporation, or if you're required to file tax returns, including employment, excise, fiduciary, or alcohol, tobacco, and firearms. Your type of business may not be required to get an EIN, but you may need an EIN for dealing with other businesses, including banks that require an EIN to set up business accounts, such as for loans. The IRS will give you an EIN even if you don't need it for IRS purposes. The fastest, free, and easiest way to get an EIN is online. You just need to go to irs.gov/EIN or go to irs.gov and type in EIN in the search. And then from there, you'll find out more information, including the application. The EIN assigned is the permanent federal employer identification number for your business. This EIN may be canceled if the name or social security number of the principal officer does not match the Social Security Administration records, or if your business already has an EIN. I'm going to move on to the next slide. So I'm going to cover record keeping next for your business. So as a business owner, you have to keep receipts, sales slips, invoices, records for cash receipts and expenditures, bank deposit slips, canceled checks, bank statements, and other documents to substantiate items of income, deductions, and credits. Although it may sound like a lot of work, unless you have records showing the source of your receipts, you may not be able to prove that some are non-business or non-taxable. So you just want to remember that recording these items is going to help you pay only the tax you owe. So let's look at how in-depth your records need to be and how long you need to keep them. Your records have to support the claimed amount, the time and the place, the business purpose, and your business relationship to any other person involved. If your records are incomplete, they may not support your deductions. You have to keep your records if their contents may be material in the administration of any Internal Revenue Service law. So usually the statute of limitations for an income tax return expires 3 years after the return is either due or filed, or 2 years from the date the tax is paid, whichever is later. To support items of income or deduction on your tax return, you have to keep records until the statute of limitations for that return expires. So there's special record keeping rules if the records are connected to a property. Generally, these records need to be kept until the period of limitation expires for the year in which you dispose of the property. You have to keep these records to figure any depreciation, amortization, or depletion deduction, and to figure the gain or loss when you sell or otherwise dispose of the property. Deborah, did you have a question? Okay, moving on. If you receive
No questions right now. Sorry.
Do I what?
No questions right now.
Okay, thank you. If you received property in a non-taxable exchange, your basis in that property is the same as the basis of the property that you gave up, increased by any money you paid. Now, you have to keep the records on the old property as well as the new property until a period of limitation expires for the year in which you dispose of the new property. If you have employees, then you have to keep employment records too. You have to keep all employment tax records for at least 4 years after the date in which the tax return becomes due or the taxes are paid, whichever is later. And there's some circumstances where records have to be kept even longer. If you change what's called your method of accounting, which I'm going to explain later, the records supporting the necessary adjustments have to be material for an indefinite amount of time. And as discussed earlier, the records that establish the basis for original or replacement property have to also be kept longer. Now, if you lost your records due to circumstances beyond your control, such as flood or an earthquake, you can substantiate a deduction by what's called reasonable reconstruction. If that's your situation, IRS has publication 583 called Starting a Business and Keeping Records, and it'll tell you more about that. We also have our IRS publication 15 called Employer's Tax Guide that talks about employment tax records. And it's as easy as going to irs.gov and typing in Pub 583 or Pub 15. Another way is to go to irs.gov and do a search with the words record keeping. Okay, moving on to the next slide. Okay, bookkeeping systems. Many people who operate their own one-person business, they never bother to set up a business bookkeeping system. Their personal checking account serves as both a personal and a business account. However, did you say something, Deborah? However, the IRS recommends that you open a separate business bank account. There's 2 types of bookkeeping systems, something that we call single entry and something that we call double entry. So single entry is the simplest to keep with a single entry system. All you do is record a daily and a monthly summary of your business income and a monthly summary of your business expenses. Now, this system, it focuses on the business's profit and loss statement and not on its balance sheet. So while single entry is not a complete accounting system, it shows income and expenses in enough detail for tax purposes. The double entry system is more complex. It has built-in checks and balances. It's self-balancing and it's more accurate than the single entry system. Because all businesses consist of an exchange of one thing for another, double entry bookkeeping is used to show this twofold effect. Now, many people who operate their own one-person business, let's go on to, here we go. Once you've selected a bookkeeping system, you also need to select an accounting method. Your accounting method is a set of rules that you use to decide when and how you report your income and expenses. The two most commonly used accounting methods are called the cash method and the accrual method. So on your tax return, you have to use the same accounting method that you use to keep your records. Under the cash method, you report all the income in the year you receive it. You usually deduct expenses only in the year in which you pay them. Whereas under the accrual method, you report income in the year that you earn it, regardless of when you receive the payment. And you also deduct expenses in the year that you incur them, whether or not you pay them that year. Businesses that have inventory for sale to customers have to generally use an accrual method for sales and purchases. However, there's many small businesses with gross receipts averaging less than $10 million a year, and they can use a cash method for sales and purchases. So for more information on the differences between the cash and accrual methods of accounting, you can take a look at IRS Publication 538, Accounting Periods and Methods. So there are computer software packages that are very useful. They're really easy to use and they require very little knowledge of bookkeeping and accounting. You just want to be careful. If you use software, you have to be able to produce records from this system to support what is on your tax return. And you can use electronic records as well. So you just want to make sure that you always keep a backup copy and keep it in a safe place. So up to this point, I've covered quite a lot. And so I'm actually going to test your knowledge. But here we go. Sandy is a business owner, and you decide whether she is using the correct accounting method. So Sandy has a website where she sells custom ordered and handmade knitted goods, hats, scarves, and socks. Her customers order online, but because it could take a few weeks or even a few months to get the supplies and finish the order, she doesn't charge them until the product ships. So she uses the accrual method of accounting. And then she records the sale in the month when she ships the product, not in the month that the person orders it. So is Sandy correct in using the accrual method? So go ahead and type your answers in the chat, and I'll give you a couple of minutes.
Go team.
All right, Deborah, you want to read the answers?
Have any answers right now? Does
Oh,
anyone know? Is Sandy correct in using the accrual method?
or should she be using the cash method? All right, well, I'm gonna move on. The answer, I hope you get the answer right in real life is yes, she can use the accrual method of accounting. And the reason is this method can be used because there can be some length of time between when a customer places an order and when it ships. And Sandy records revenue when the customer is charged. So that is when she ships the order. All right, we're going to move on.
There's a question in the chat box. So the question is, how can we tell which she should use?
If she is not recording the the sale when she receives the cash, then that would be the cash method, as opposed to the accrual method. She's recording the sale when she ships the item. So that's the difference. And you can also go and take a look at IRS publication 538, which goes over the differences between the cash and the accrual methods of accounting. Okay.
Okay, there is another question. So Rodney says he sees the difference, but he doesn't understand the why. I see the what, but not the why.
Okay, so the why you would want to use an accrual method would be if you were asked from the bank for something called a balance sheet, where you have to show not only where the money was coming out of the cash, but what it was applied to as far as an expense. Whereas the cash method is you're only going to be able to produce an income statement from that. And so when you hear the term net worth, that usually is referring to something called a balance sheet, where you've shown what your equity is in the firm. You show not only what your expenses and income are, but what assets it goes towards. And if you're just using a cash method, you won't be able to tell what assets that you have going back and looking at those statements easily, I should say. Like if you have equipment to depreciate, you're going to want to use the accrual method. So that's another reason for the accrual method.
Does that make sense, Rodney?
Well, I'm very, very visual when it comes to accounting, so it won't make sense to me until I see it happen in action.
Okay, so
Okay.
you're going to want to take a look at publication 538 then, where it gives you hard examples, and also just a basic accounting class. If you have time at a community college, would
No, we'll
help you.
go over it with the business incubator. We'll go
Okay,
over it. I'll make sure we schedule that session
perfect,
so that everyone can have a clear understanding of it. I'll check
perfect.
the availability of Blaise. He's a tax expert, and we had a session on, I believe, bookkeeping with the two methods, but we didn't go in depth when it comes to the financial statements, balance sheet, income statement, and the statement of cash flow. So we'll go over that.
Okay, so this probably isn't making a lot of sense until you have a chance to know the difference between an income statement and a balance sheet. So, okay, that sounds good. Let's move on to types of business structures. Early in the life of your small business, you need to decide on the structure of ownership. There are 5 common types of business organizations: sole proprietorship, partnership, corporation, S corporation, and limited liability company. So I'm going to go over the advantages and disadvantages of each. You can also go to the Small Business and Self-Employed Tax Center on irs.gov by typing in /smallbiz after the URL, or you can also do a search for business structure and then look at information for under each section. So let's move on. Okay, sole proprietorship. So a sole proprietorship is what's called an unincorporated business that one person owns. And the advantage of a sole proprietorship is it's the simplest type of business organization. And the sole owner of the business has complete control over all the decisions. The sole owner is not required to consult with anyone else to make decisions or changes. And the disadvantages of sole proprietorship are the business does not exist apart from its owner. And it's the owner who assumes the risks of the business to the extent of all of his or her assets, even if the owner does not use his or her personal assets in the business. Additionally, the ability to finance the business, known as capital, is limited to whatever the owner can come up with, including loans from financial institutions of which the owner is personally responsible. So a sole proprietor files his or her taxes using a form called a Schedule C, which is called net profit from business. And the Schedule C is included with the Form 1040 to report the profit or loss from operating the business. The sole proprietor is also going to file something called Schedule SE, which stands for self-employment tax, to report Social Security and Medicare taxes on net profits of the current year's threshold. So if you or your spouse jointly own and operate an unincorporated business in a non-community property state and share in the profits and losses, you're partners in a partnership and you're not a sole proprietorship. So you should not use a Schedule C, but there are exceptions to this. For example, if you and your spouse wholly own and operate an unincorporated business as community property under community property laws of a state, you can treat the business either as a sole proprietorship or a partnership. Now, there's another exception for qualified joint ventures for spouses. If you or your spouse each materially participate as the only member of a jointly owned and operated business, and you file a joint income tax return for the year, you can make a joint election to be treated as a qualified joint venture instead of a partnership. So this allows you to avoid the complexity of a partnership Form 1065, which is used for U.S. return of partnership income, but it still gives each spouse credit for Social Security earnings in which retirement benefits are based. So for this, we do have another publication, IRS Publication 334, called Tax Guide for Small Business. And you would want to focus on the section called For Individuals Who Use Schedule C. Okay, so now we're going to move on to partnership. The second type of business organization is a general partnership. And this is a relationship between two or more people who come together to carry on a trade or business. Each person contributes money, property, labor, or skills, and each expects to share both in the profits of the losses of the business. And there's no limit as far as how many people can join in a partnership. Advantages is that it's easy to organize, it has a definite legal status, and it may have a greater financial strength than a sole proprietorship. The first disadvantage is that decision authority is divided. The other disadvantage to a partnership is that the liability of the partners is usually unlimited unless otherwise stated in the partnership agreement. So, in other words, each partner may be held liable for all the debts of the business. For example, if one partner does not exercise good judgment, that partner could cause not only the loss of that partner's ship's assets, but also the loss of the other partner's personal assets. Partnerships, they report profit or losses on, again, Form 1065, which is called U.S. Return of Partnership Income, which summarizes the business activity of the partnership. A partnership does not pay tax on income from daily operations, and all the income, losses, deductions, and credits generated by a partnership, and it actually passes through to the partners. And then each partner gets a Form 1065-K1, which is called Partner Share of Income Deductions and Credit. And then the partners report these items on their personal income tax returns. Partnerships still have to file employment tax returns and pay employment taxes on employees' compensation. And if you like more information about partnerships, you can take a look at IRS publication 541, and it's called Partnerships, as well as taking a look at the form that's used for partnerships called Form 1065 and 1040.
Yeah, I have a question.
Yes.
So let's say from operations, you said income from operations, right?
It's the
They
net
do not pay
then
taxes on.
it's the net profit or loss. The partnership itself doesn't file a return that's taxable, the 1065. The 1065-K1, it splits up that 1065, and then every partner gets a K1 that they include as income on their tax return.
Equally divided, or how
That
does that work?
that probably depends on the agreement within the partnership.
Gotcha. Okay.
Yeah. So you want to be careful with these because I have seen where one partner, the first partner that says they don't have anything to help pay for anything, and then the other partner gets stuck with having to pay whatever liability the other partner can't pay. So you always, with this, definitely want to get an attorney to take a look at everything first for you. And you also want an attorney involved if you're going to choose a corporation. So corporations, they're treated by law as legal entities, meaning the corporation has a life separate from its owners and has rights and duties of its own. So the owners of a corporation are known as stockholders or shareholders. And it might be worth noting that one person can be the sole shareholder of a corporation. It doesn't have to be multiple people like in a partnership. Managers of a corporation, they may or may not be shareholders. And forming a corporation involves the transfer of money or property or both by the prospective shareholders in exchange for capital stock in the corporation. Now, for purposes of federal income tax, corporations include associations, joint stock companies, and trusts, as well as partnerships that operate as associations or corporations. So, covering the advantages and disadvantages of a corporation, advantages are that the stockholders have limited liability for corporate debts or actions. Another advantage is that transferring the ownership is easy. The stock can be sold, and raising capital and expanding the business may be easier. Disadvantages are that the corporation is subject to tax on its income at the corporate level, and then when the income is distributed to dividends, that income is taxed again at the shareholder level. You always hear about double taxation with corporations. That's what they're talking about. Owners of a corporation who work in the business are typically considered employees. They're paid a salary, and both the corporation and the employee pay employment taxes on that salary. So again, you want to talk to not only an accountant, but also an attorney, and preferably specializing in corporate law, since corporations are more difficult and expensive to organize than other business structures. And the corporate charter filled with the secretary of your state restricts the type of business activities and is subject to many state and federal controls. If you file a tax return for a corporation, you're going to file a Form 1120 called U.S. Corporation Income Tax Return. So if you're interested in this, there is an IRS publication, 542, called Corporations for more information. Now let's move on to S corporations. S corporation is a small business corporation whose shareholders elect to report corporate profits or losses in the same manner as that of a partnership. Like partnerships, S corporations do not pay tax. Unlike S corporations, the C corporations are taxed at the corporate level, and then when the income is distributed as dividends, it's taxed again at the shareholder level. The organizing shareholders of a corporation who wish to avoid double taxation, they can file a Form 2553 called Election by a Small Business Corporation, and they'll want to submit this by the 15th day of the third month of the first S corporation year. So to give you an example to help clarify the process, let's say your first S corporation tax year begins on January 1st. So you have to submit Form 2553 by March 15th. Otherwise, the election is effective for the next tax year. Then what happens is the IRS is going to mail you something called a CP 261 notice of acceptance as an S corporation, to let you know that IRS received it and approved your election. Now, you should receive your approval in 60 days. If you don't, you can contact the IRS campus where you mailed your Form 2553, and this goes into more detail on the instructions on Form 2553.
I have a question, Nikki.
Mm-hmm.
So last year I submitted the Form 2553
Mm-hmm.
to be considered as an S corp,
Mm-hmm.
but I didn't do it within the time frame. I did it after March 15th.
Okay.
And it's been more than 60 days. I haven't received that confirmation yet.
Okay. What you'd want to do is take a look then at your instructions on the
Mm-hmm.
Form 2553 and write to them and ask them what the status is.
Do
But you're
you have a direct, like a number? Not,
not a phone number, but there is an address on the instructions to the Form 2553.
so use that one.
Yeah, refer back to the instructions on irs.gov. Just type Form 2553 instructions and follow that.
Okay.
Yeah. Let's see. Okay, so this is kind of like a pass-through, like partnerships. Beauty about it is you don't have to worry about double taxation at the corporate level and at the individual level. In this case, it would be the shareholders level. It bypasses being taxed at the corporate level and just gets taxed at the individual level, or shareholders. Ugh, shareholders. Sorry about that level. Okay, let's move on to limited liability company. So this is the last structure I'm going to go over. It is a legal entity created under state law, and the advantages and disadvantages are different. The LLC is separate from its owners, who are referred to as members. An LLC can own property, it can incur debt, and it can enter into contracts. They're really popular because their members, not owners, are personally protected against the LLC debts. They have limited personal liability for the debts and actions of the LLC, and without many of the formalities of a corporation. This is an advantage for this type of business organization. Other features of LLCs are more like partnerships, providing management flexibility and the benefit of flow-through taxation. Now, for federal income tax purposes, we don't have an LLC form. You have to, I'm hearing an echo.
Justin, can you mute yourself, please?
Okay.
Okay, so an LLC has to be treated at a federal level as either a sole proprietorship, a partnership, or a corporation. And also for federal tax purposes, owners or members of an LLC can make an election to be treated as either a disregarded entity or a partnership. So if you want to tell the IRS how to treat your business for federal income taxes for LLC, you need to file form number 8832, which is called Entity Classification Election. If you don't file this form, the IRS is going to treat your business as a sole proprietorship by default. And so this is if it has a single owner or if it's a partnership, if it has two or more members.
There's a question.
Yes.
Is an LLC protected against its members' debt?
Yes.
Okay.
Yes.
The other question is, you said you can elect to be treated as a disregarded entity?
And I don't know what that is.
That was the question.
Sorry.
Okay.
I can find out what is a disregarded entity.
Yes, please.
All right. Okay.
Look it up.
I was hoping you weren't going to ask that.
Answer your question. She said yes.
Okay. So there's instructions with that form that explain the classifications. Okay, there you go. So you would want to go to the instructions of form 8832 in order to find out what that is. But if you want, I can go to it right now. So let me, because I want to know what it is.
Mm-hmm.
Okay. I'm going to go to irs.gov. We're going to do a search for form 8832 instructions. Beauty about working for the IRS is even after 30 years, you're still learning.
So guys, if you have any questions, please, this is the time to ask a question. Everyone on this call has an LLC, and we have new LLC owners. So this will be your first year to file your taxes with your business. So if you have any questions, please feel free to ask your questions.
Okay, I've pulled up the page that on irs.gov that says about Form 8832 NAD classification election. And it says an eligible entity uses Form 8832 to elect how it will be classified for federal tax purposes as either a corporation, a partnership, or an entity disregarded as separate from its owner. So to me, that's if it's disregarded as separate from its owner, that tells me it is regarded as enjoined with its owner, meaning sole proprietorship. But let me see if I can find something more definite. Recent developments. I'm going to do a search.
Okay, so I
Disregard.
did a little bit of search. It says
Uh-huh,
a disregarded entity is a business entity
uh-huh.
that has a single owner, and it is
Okay.
not organized as a corporation and has not elected to be taxed as a separate entity for
Uh-huh.
federal tax purposes.
Okay, so I was right then. It defaults
Yes.
to a sole proprietorship.
Mm-hmm.
Okay. I don't read legalese too well sometimes. Okay, where was I? Okay, so we're going to move on to what IRS calls sharing or gig economy. IRS calls it gig economy. The rest of the world calls it the sharing economy. So gig economy income is taxable if you earn income as a rideshare driver, a rental host, or online seller. Your business is part of something called the gig economy. This is any activity where people earn income providing on-demand work, services, or goods, and it's often through a digital platform like an app or a website. And so if you, let's say, have an Airbnb, if you're a driver, you want to go to irs.gov and check out what's called the Gig Economy Tax Center. And they'll talk about general information about tax issues that arise from the gig economy and how to file your taxes. Okay. It's that time. If you are starting to get into complex tax situations, you might be thinking about getting a paid tax preparer for the first time this year. So, before I delve into this, I just want to say from the beginning, if you do decide to use a paid preparer, remember you're still legally responsible for the information on your own tax returns. So let's go over some points you need to be aware of. First, you want to avoid preparers who claim they can obtain larger refunds than others. Second, you want to avoid preparers who base their fee on the amount of your refund. And then also you want to avoid preparers who will not sign a tax return or won't give you a copy for your records. Also, you never want to sign a blank tax return, and you never want to sign a completed form without reviewing it and making sure that you understand that tax return. Finally, you want to consider whether the preparer is going to be around, say, a year or two later after the return is filed and you potentially get caught up in audit with it. So the IRS now has a registration and certification process for preparers. So to make sure that you're working with an honest and reputable preparer, you want to make sure that the paid preparer has a valid IRS preparer tax identification number, also known as a PTIN. And all preparers, whatever their professional designation across the board, they have to at least have a valid PTIN. So you can find more tips on irs.gov by typing choosing a tax preparer in the search box.
Nikki, there is a question here.
Yes.
The question is, are you going to cover the rules about collecting tax? Rodney, can I ask can you mute yourself and provide some clarifications? What do you
Sure.
mean?
So, like when we are selling our products to someone and we have to collect tax, like
Mhm.
the rules regarding that, because I think that's a mistake I made last year. I
Mhm.
didn't know that I had to consider like different counties in the state and stuff like that. And then I was told by one accountant that for one business, since I make websites, that I don't have to collect tax. But then the state of Nebraska was like, no, you got played. So I'm just trying to
Mm-hmm.
figure out what's right.
Yeah, you're talking about sales tax,
Mm-hmm.
is what you're and IRS does not oversee sales tax. That is the state of Nebraska. I can refer you to a speaker on that, Deborah,
Okay.
so that you can have somebody speak on just sales tax.
Okay, I will love that. We'll connect after this so we can do that. But Rodney,
Okay.
I don't know what software you use. I do. The one that I use will tell you the percentage, and I do know that because my business initially was registered in Sarpy County, and in Sarpy County, it's, if I'm not mistaken, 7.5, but in Douglas County it's 7%. So I had to take that into consideration when I relocated my business from Sarpy to Douglas. It's easier if you use a software like QuickBooks. I prefer Wave Apps, and it does the math for you automatically. Um, about your website thing, to be honest, I had the same understanding that you did, so I'm going to look into that more. Do you have a contact from the state when
I
it
do.
comes to the sales tax, Rodney?
Oh,
Yeah, the state of there was a guy who emailed me after I submitted my taxes, and he told me, okay, Sunflare is fine. You just have to remember next time that there's different counties had different taxes. But
Mm-hmm.
for Cousin Mercury, um, you you don't have to. He said you don't have to collect taxes since you're building sites. Um,
Mm.
I don't remember his name, but I should still have his email.
Okay, I do have some contacts. I know when I do consulting work, there is no tax, but when I sell products like t-shirts or um, when I print business cards and all that, yeah, there is taxes apply. So I will look for that contact and I'll provide you with additional information. And then Nikki will also look for um your contact. Devanis, do you have a question?
Oh no.
Okay.
okay. So we're ready to move on, or
I
um,
do know Sarpy County's taxes are tricky because I like Springfield and Gretna and Bellevue is like 7%, but like Papillion and La Vista is 7.5.
Yes.
mm,
So tricky.
yeah, I realize I'm only like a tiny piece of your pie, so I get it. All right, let's move to choosing a paid tax preparer. When I went to college, the only thing they ever mentioned to me was CPAs. That's all that I ever knew that existed. But there are tax preparers called enrolled agents. There's the CPAs. There are tax attorneys. And then there is annual filing season preparers that have nothing but a P10, and they're just called P10 holders. So I'm going to cover each here with you. Enrolled agent is a person who has earned the privilege of representing taxpayers before the IRS. Most of them have passed a 3-part comprehensive IRS test covering individual and business tax returns and client representation rules. They have to adhere to ethical standards and complete 72 hours of continuing education courses over 3 years. And they have unlimited practice rights, which means they are unrestricted as to which taxpayer they can represent, what types of tax matters that they can handle, and which IRS offices they can represent clients before. So to learn more about enrolled agents, you can either do a search for something called Treasury Department Circular 230, or you can visit irs.gov and just type in enrolled agents in the search box. Now, some individuals become enrolled agents through experience as a former IRS employee instead of passing the three-part test. And these individuals may be limited in their practice rights to only the matters that they have expertise in as a former employee. And this is generally only with our former revenue agents or people that have auditing experience. Okay, whereas CPAs and attorneys, both of them have their own professional requirements for continuing education. Both groups have unlimited practice rights before the IRS. And then there's something called annual filing season program participants. And this voluntary program recognizes the efforts of return preparers who generally are not attorneys, certified public accountants, or enrolled agents. So it's designed to encourage education and filing season readiness. The IRS issues an annual filing season program record of completion to these return preparers who obtain a certain number of continuing education hours in preparation for a specific tax year. Beginning with tax returns filed after 2015, only the annual filing season program participants have limited practice rights, meaning that they may only represent clients whose returns they have prepared and signed, but only before revenue agents, customer service representatives, and similar IRS employees, including taxpayer advocate service. They cannot represent clients whose returns that they did not prepare, and they cannot represent clients in front of our appeals or collection issues, even if they did prepare the return in question. So P10 holders, tax return preparers who have an active preparer tax identification number, but no professional credentials and did not participate in the annual filing season, they're authorized to prepare tax returns, and that is the only authority that they have as of 2016. They have no authority to represent clients before the IRS except regarding the returns they prepared and filed from the end of 2015 and before. Now, there is something called the Directory of Federal Tax Return Preparers with Credentials and Select Qualifications. It is a public directory that IRS has with certain tax professionals. It's a database that's searchable, where it includes the name, the city, the state, and the zip code of attorneys, CPAs, enrolled agents, enrolled retirement plan agents, and enrolled actuaries with valid P10s, as well as annual filing season program record of completion recipients. So to find that in that little search box on irs.gov, you're going to enter Directory of Federal Tax Return Preparers with Credentials and Select Qualifications, and you'll find a link to that database. So, do I have any more questions?
See any questions in the chat box? Does anyone has any questions?
Have I convinced anybody to go to a tax attorney before setting up your business and choosing an entity? Hopefully, I've convinced at least one or two of you. I'm sorry I can't answer your sales tax questions. But I know somebody that can answer those questions, and she's really good at presentations.
Is she with the state of Nebraska or with the IRS?
State of Nebraska. Yeah,
Okay.
you're gonna need somebody from the state to go over sales tax with
Yes.
you.
Okay. And you
All right.
said you provide us with that information?
I'm going to provide you with that information, Deborah. She doesn't
Okay.
want her contact information published. I
Okay.
just put it out there for me. I don't care.
Okay.
But a lot of the government employees, they're cautious. So yeah, I'll give you her information, and then you
Okay.
can contact her directly.
Okay.
So,
Thanks in advance.
well, best wishes on all of your new businesses, everybody. So Deborah, I'll turn it back to you.
All right. Thank you so much. You can stop sharing, Nikki, if you
Okay.
don't mind.
Stop
All
share.
right.
Okay.
Thanks everyone for joining tonight. I hope you guys have a great start of 2025, and this is our first webinar of the year. If I'm not mistaken, I think the first class is scheduled for February 3rd, and our speaker is going to be BC Clark, and we will be moving into a new space beginning February. I don't know if you guys have visited the exchange. It's on North 24th. It used to be Habitat for Humanity. They used to have their offices there. Now they just have a warehouse. So we'll be using that space a lot. It has a lot of amenities that I believe at this stage of your respective businesses, um, you guys need. Let me stop the, this is also being